week's market update. Continuing turmoil in emerging markets, Canada and Trump at loggerheads, and US stocks continue to hit new records. The Goldilocks market backdrop continues. Some markets are distinctly too cold. China and other emerging markets spring to mind, while others are piping hot. India and the US, for example. Others, like Japan, reasonable value with better growth than investors are giving it credit for, look just right. Starting with the markets no one likes. Emerging markets remain in the spotlight as currencies in particular are friendless in the face of continuing trade tensions and a soar away US currency that's making it ever harder for the developing world to finance dollar-denominated borrowings. Equities too have been hit hard, with the MSCI Emerging Market Index at its lowest level for more than a year and 25% below its January peak. Argentina is in focus this week, and with 80% of its total sovereign debt in the form of dollars, it's not hard to see why. Its peso dropped 7% on Wednesday last week and then endured a further double-digit decline on Thursday as the cost of insuring against default soared. The Argentinian currency is neck and neck with Turkey's lira in the race to be the worst performing currency against the dollar this year. Having gone cap in hand to the IMF last week to ask for an accelerated disbursement of a planned $50 billion support programme, President Mauricio Macri this week abandoned his gradualist approach to reform and unveiled a sweeping new austerity programme to regain the trust of international investors. Buenos Aires will raise taxes and slash bureaucracy to cut its fiscal deficit, which hit 3.9% of GDP last year. Turkey this week also finally succumbed to pressure from the markets to intervene. Its central bank said it would probably adjust interest rates next week after new data showed inflation running at nearly 18%. That's 4 times the targeted rate. This is a major U-turn, as the central bank has recently bowed to President Erdogan's demand that it hold back from using monetary policy to tackle inflation and support the currency. He describes himself as an enemy of high interest rates. Argentina definitely is not an enemy of high rates. Its currency slide came despite the country's central bank raising interest rates to a record 60%, up 15 percentage points. Investors, however, have shrugged off the central bank's actions, focusing instead on how the government plans to reduce Argentina's fiscal deficit and meet the IMF's conditions for loaning the country $50 billion in bailout funds. The optimistic view is that Argentina's and Turkey's pain is idiosyncratic and won't trigger a wider contagion to other emerging markets. The evidence so far is not so encouraging. Yesterday, the South African rand fell 1% against the dollar, and Mexico's peso was off 0.5%. Russia's ruble was 0.7% lower, while the Indonesian rupiah has fallen to its lowest level since Asia's financial crisis. In India, the rupee has fallen to a record low of 71 to the dollar, despite growth of 8.2% in the Indian economy, its fastest expansion in 2 years. And a stock market that has parted company with other emerging markets. The Bombay Sensex index has doubled over the past 5 years and has diverged from other major Asian markets this year, as investors have viewed it as a relatively safe haven at a time of international trade tensions. India is less dependent than most emerging markets on external trade. The Chinese market, by contrast, has lost a quarter of its value since peaking in January, on the back of worries about a trade war with America and Beijing's efforts to rein in credit growth in an overborrowed economy. Against this backdrop of continuing emerging market turmoil, Wall Street looks like a port in the storm, and both the S&P 500 and Nasdaq indices have hit new record highs in the past week as investors warm to tax cut-fueled earnings growth and rock-bottom unemployment. The US market has also been boosted this week by an apparent victory for America in its standoff with Mexico, although the negotiations with both Canada and China are a long way from a happy conclusion. Donald Trump has threatened to impose tariffs on a further $200 billion of Chinese imports, while over the weekend the president took to Twitter again in a storm of abuse levelled at Canada. America's northern neighbour is looking a lot less keen to sign up to the White House's America First trade proposals. Also hit hard by trade tensions so far this year has been the Japanese equity market, although here a growing mismatch seems to be developing between historically low valuations and an economy that's in better shape than for some time. With unemployment at half the 2010 level and more jobs available than at any time since the 1970s, salaries and bonuses are rising. The 9% fall in the Topics index from its peak earlier this year looks like a serious anomaly. At just 12 times expected earnings, Japanese equities are much cheaper than their developed world counterparts in Europe and especially the US. On this side of the pond, the stock market remains enthralled to the exchange rate, with a fall in the value of the pound yesterday sending the FTSE 100 nearly 1% higher as the outlook improved for Britain's exporters and overseas earners. The main trigger for the pound's fall was the worst manufacturing data for 2 years, hit in particular by exports which for the past 2 years since the referendum have countered weakness in domestic demand, but are now being hit by a slowdown in global demand. The slide in sterling, down below $1.29 after briefly rising above $1.30 again, also followed another negative turn in the ongoing Brexit saga, as Boris Johnson, the Brexiteer former Foreign Secretary, said in his Daily Telegraph column that Prime Minister Theresa May's Chequers plan would be a disaster for Britain. That followed equally unhelpful comments from EU chief negotiator Michel Barnier, who said he strongly opposed what he described as the illegal Chequers plan, because it sought to unpick the EU's single market. Barnier is digging in his heels for fear that British cherry-picking would encourage other countries to look for their own bespoke arrangements. With UK MPs back from their summer break today, the Brexit battle will resume in earnest. And meanwhile, in one more Brexit-related development, Mark Carney, the Governor of the Bank of England, is coming under pressure to clarify whether he would be willing to extend his tenure at the central bank. He's reported to have indicated that he could stay on to see the Brexit process through, which some would welcome. He was seen as a steady hand on the tiller after the referendum, but others would not. He's been a constant thorn in the side of Brexiteers, warning of the dangers of a no-deal exit. Although this looks like being another quiet week on the data front, things are definitely picking up steam on the corporate front. In the UK, the focus is very much on the house builders, which had been strong stock market performers on the back of lower for longer interest rates and the government's Help to Buy scheme. More recently, however, they've fallen back as the housing market has stalled and company managements have become significant sellers of their own company shares. This week sees Redrow, Barratt and Bovis reporting. Redrow actually kicked things off this morning with a call shared by many business leaders, of course, for greater clarity over Brexit to boost market confidence. On the data front, the main event is Friday's non-farm payroll report. The US economy is firing on all cylinders and investors will want to see ongoing strong job creation to reassure them that this is likely to continue.